You retire at 63, watch your tax bill drop for 10 clean years, and then you turn 73 and the IRS hands you a piece of paper that resets everything. That paper is not a bill, it is a schedule. And if you have between $500,000 and $2 million sitting in a traditional IRA or 401k, I'd argue that schedule is going to put you in a higher bracket than you ever paid while working. I keep seeing this with the same kind of saver. You did everything right, you maxed contributions, you got the match. Vanguard's How America Saves 2025 report shows the average 401k balance for workers between 55 and 64 is $271,320, while the median is only $95,642. That gap is the whole game. The median saver is fine. The above-average saver got hosed and does not know it yet. If you are in that above-average group, the rule you have heard your entire working life that you will be in a lower bracket once you stop working is mathematically backwards for you specifically. Not well, it depends backwards. Backwards. Here is why. Required minimum distributions are not optional. The Secure 2.0 Act pushed the start age to 73 for people born between 1951 and 1959 and to 75 for people born in 1960 or later, so you get a runway. Then the runway ends. When it ends, the IRS uses the Uniform Lifetime Table. At 73, the divisor is 26.5. At 75, it drops to 24.6, which means the forced withdrawal grows every year. Picture it. You wake up at 73 with $1.2 million in a traditional IRA. You divide $1.2 million by 26.5. That is roughly $45,200 you are forced to withdraw and pay ordinary income tax on. Whether you need it, whether you want it, the IRS does not care. And that is just one tax. It triggers 3 others. This is the part that drives me crazy because nobody walks you through it. One required minimum distribution creates 4 separate tax problems at the same time. Bracket creep on the withdrawal itself. Then your Social Security gets taxed harder. Then your Medicare premium goes up. Then your capital gains rate creeps. 4 hits from one paper. Start with Social Security. The thresholds were set in 1983 and 1993, and this is the part that drives me crazy. They have never been adjusted for inflation. For a married couple, once your combined income clears $32,000, up to 50% of your benefits become taxable. Cross $44,000 and up to 85% of your benefits become taxable. 40 years of inflation turned a wealthy retiree tax into a tax that catches almost any retiree with real savings. Picture a couple at 75, $40,000 in Social Security benefits, a $48,000 required minimum distribution, some pension. They blow through the $44,000 combined income threshold before they finish their morning coffee, and now 85% of that $40,000 in Social Security, $34,000, gets stacked on top of the RMD as ordinary income. $34,000 they thought was theirs. Now it is taxable. If you are watching this with a spouse and you have not modeled this, hit like because the next part is worse. Then Medicare hits. The 2026 Standard Part B premium is $185 per month. IRMAA surcharges begin at $103,000 of modified adjusted gross income for single filers and $206,000 for married filing jointly. And IRMAA uses a 2-year lookback. So a required minimum distribution that pushes your income over the line in 2026 does not raise your premium until 2028. By then, you cannot undo it. Then your capital gains creep. For the 2025 tax year, married couples with taxable income up to $96,700 paid 0% on long-term capital gains. Above that threshold, 15%. Above $533,400, 20%. So when ordinary income from your RMD pushes your taxable income up, qualified dividends and gains that were tax-free yesterday are taxed today. Same investments, higher rate, because of one withdrawal you never wanted. 4 hits, 1 paper, stacked. So how big is the bill if you do nothing? On a $1.2 million IRA at 73 with a $45,000 RMD plus $40,000 of Social Security, you are looking at a household income that crosses every single one of those 4 lines simultaneously. Bracket creep, 85% SS taxation, IRMAA Tier 1 or 2, cap gains pushed out of 0%. The effective rate on the next dollar can run higher than the rate you paid in your peak earning year. I have watched smart people walk into their 70s and get gut-punched by this. You might be thinking, tax rates could fall. Maybe Congress changes things. Maybe the math reverses. The 2017 Tax Cuts and Jobs Act individual rates expired on December 31, 2025. The legislative environment is genuinely uncertain, but here is the thing. Even if rates stay flat, the four-way stack still fires. The Social Security thresholds are still frozen. IRMAA still has a cliff. The RMD divisor is still 26.5. The mechanics do not need higher rates to bite. They bite at today's rates. Now the second hit. When one spouse dies, the survivor files single. The standard deduction drops from $32,200 married filing jointly to $16,100 single for 2026. The 2026 24% bracket for married filing jointly starts at $211,300 and runs to $402,650. The single filer thresholds are roughly half, so the surviving spouse often has lower household income and a higher effective tax rate and a higher Medicare premium because IRMAA recalculates on single filer thresholds. And yes, before you ask, the temporary $6,000 per person age 65 plus deduction available through 2028 helps a little, not enough to fix the cliff. I'd argue the widow's scenario is the single most underserved topic in retirement tax planning. Most couples never model it. The math does not care. If you have a spouse, drop your situation in the comments, your balance range, your age, whether you have a pension below. Here's what changes the outcome. The gap years between when you retire and when RMDs start are typically the lowest income window you will ever see again. No salary, no RMDs yet, maybe deferred Social Security. The math experts have been clear on this for years. The gap years are optimal for Roth conversions because every dollar you move from traditional to Roth at today's controlled rate is a dollar that never gets caught in the four-way stack later. Roth accounts have no required minimum distributions during the original owner's lifetime, so that converted dollar is permanently out of the forced withdrawal schedule. But, and this is non-negotiable, the conversion strategy has 3 traps that blow it up if you whiff them. First trap. IRMAA's 2-year lookback means a conversion in 2026 raises your 2028 Medicare premium, so you have to size the conversion to stay inside an IRMAA tier, not just inside an income tax bracket. They are different lines. Cross the IRMAA line by $1 and the surcharge applies for the entire year. It is a cliff, not a slope. Second trap. The Social Security torpedo. If you are already taking Social Security and your conversion pushes combined income past $44,000, suddenly 85% of your benefits become taxable. So a conversion dollar can effectively cost more than its marginal rate suggests, because the dollar that triggers SS taxation is paying tax on itself and on roughly 85 cents of Social Security at the same time. Third trap, the 5-year rule. Each Roth conversion has its own 5-year holding period before the converted principal can be withdrawn penalty-free if you are under 59.5. So if you are 68 and planning to retire at 73, conversions you do today clear the clock before RMDs begin. Conversions you do at 72 do not. If you found this useful so far, subscribe so you can get more. Now the hard part. Pay the conversion tax from non-IRA funds, a taxable brokerage account, cash, not from the converted IRA itself. Picture 2 couples doing the same $100,000 conversion. Couple A pays the $24,000 tax bill from their brokerage account. Their full $100,000 lands in Roth and compounds tax-free. Couple B pays the same tax bill from inside the IRA, so only $76,000 actually makes it to Roth. Same conversion on paper, wildly different break-even math. And if your heirs are non-spouses, the Secure Act gives them 10 years to drain whatever they inherit. 10 years of tax-free Roth compounding versus 10 years of forced traditional IRA distributions taxed at their bracket. If your kids are doctors at the peak of their careers, that gap is enormous. Here is the question to bring to your advisor. Have you modeled my projected RMDs at age 73 and 75, including IRMAA tiers and the surviving spouse scenario, and run a Roth conversion comparison against doing nothing, word for word? A 2025 CFP board survey found that 3 in 4 certified financial planner professionals say taxes are very important in financial planning. Saying taxes matter and actually modeling RMDs at 75 against IRMAA tiers and a single filer scenario are 2 different things. The AICPA's personal financial specialist credential exists exactly to bridge that gap, the gap between portfolio planning and tax planning. If your advisor stares at you when you ask the question, you have your answer. So when does this not apply to you? Real edge cases. If your traditional balance is modest, say the median, most of this anxiety is theoretical for you. The math does not run backwards on a $100,000 account. If you have a real pension that already fills your brackets, Conversions can push you up rather than catch you down low. If your primary intent is charitable, qualified charitable distributions let you satisfy RMDs directly from an IRA to a charity without the amount appearing in your adjusted gross income at all, sometimes a cleaner tool than conversion. The framework is a tool to figure out whether the cohort math applies to you. It is not a universal prescription. This is general education, not advice for your situation. Before you act on any of it, talk to a financial advisor or CPA, ideally one with the AICPA Personal Financial Specialist credential who can model your projected RMDs, IRMAA tiers, and surviving spouse scenario against your actual numbers. If you are above the cohort line, the lower bracket rule is not your rule. Your job for the next 10 years is to use the gap window before it closes. So once you know the gap window matters, the next question is how to actually size a conversion year by year without tripping the cliffs. That is the next video on the screen, a clear conversion strategy most people have never been walked through. I will see you there.